Hi, I'm Rob. In today's video, I'm going to be analysing the company Alibaba, from the company's basics to their stock performance. Firstly, we need to get an overview of Alibaba. So let's take a look at how their revenue is broken down. These figures are from their report in March 2021. So most of their revenue is from a segment called Core Commerce at a massive 87%. Next is Cloud Computing at 8, then Digital Media and Entertainment at 4, and lastly is a segment called Innovation Initiatives and Others at 1%. The four segments adds up a total revenue of $110 billion. Revenue seems good, but how about profit? Taking a look at their EBITDA, or earnings before interest, taxes and normatizations, we can see that only the core commerce segments posts a positive EBITDA, with a fairly high $31 billion. The rest of the segments aren't currently profitable. Let's go into each segment in a bit more detail. Starting it with by far the biggest is core commerce. As you can see, they have loads of different sections of core commerce, and don't worry, I won't break each one down, but essentially they have retail and wholesale commerce with both China and cross-borders parts. Then the remaining is made up from logistics and consumer services. The core commerce segment of Alibaba is usually why it's referred to as Chinese Amazon. Amazon had been operating domestically in China since 2004, but 3 years ago it shut down and said it would focus on cross-border selling to Chinese consumers. They faced massive competition from Alibaba and had a very low market share of around 1% in 2019. So Alibaba must have a fair few customers who spend a bit of money. Well, in 2021, the average consumer would spend over $1,450. They also had 925 million mobile monthly active users across their various mobile apps. Here we can see the massive growth of the core commerce business. Revenue has grown 36% and 43% from 2019 to 2020 and to 2020 to 2021 respectively. Then EBITDA had 21%, then 18% growth over the same period. So making great gains in revenue and keeping fairly good profit margins to also increase EBITDA. Alibaba's cloud computing segment is the third largest infrastructure as a service provider by revenue, just behind Microsoft and Amazon. Alibaba's cloud started as a need for the company to operate its own core commerce business and have transformed to offer their customers a complete suite of cloud services. Revenue growth for the cloud computing unit has also been impressive, with yearly growth over 50%. The same is not true for EBITDA, as their cloud computing unit is much younger and isn't currently profitable. However, they're moving in the right direction. I don't think this is much of a concern if revenue continues to grow. Alibaba describes their digital media and entertainment segment as a natural extension of their strategy to capture consumption beyond the core commerce business. They are hoping to increase customer loyalty and improve monetization for content providers across the ecosystem. So it seems like this segment can also benefit a core commerce business while providing its own revenue. Youku, which is fairly similar to YouTube, is the third largest online video platform in China by monthly active users. Revenue growth for digital media and entertainment has been good but slower than the other two segments, but still managing an average of over 10% growth. And similar with cloud computing, we have a negative EBITDA, but looks to be heading in the right direction. Innovation Initiatives and Others is the last sub-branch that covers multiple ventures that currently don't provide a huge amount of revenue and therefore have negative income, which has been fairly flat over the past 3 years. I won't go into all of them, but a good mention is AMAP, which has been around for 8 years and has 100 million daily active users. It was developed into a multi-application lifestyle service rather than just solely a maps provider. After looking at each segment, let's have a quick look at how COVID might have affected their business. Here we can see that clearly Alibaba are trying to show that their customers' businesses has been able to adapt to the pandemic thanks to them being able to digitize people's businesses. But more crucially, how has this affected Alibaba itself? Alibaba has said it's hard to determine the impact of COVID has had on the business operations and therefore the financial results. And to be honest, it can be both positive and negative. Obviously, the pandemic has had a massive impact on things like supply chain, workforce availability, lockdowns affecting consumer spending. However, Alibaba is a very online company and must have seen some of its areas have increased revenue because of this. But like mentioned, it's hard to say whether it's positive or negative overall. Now let's take a look at how Alibaba has been performing the past 5 years. So how has Alibaba's share price performed over the past 5 years? Share price is up 26% when compared with 5 years ago, which is a fairly poor 5.2% a year. As we can see, it's been a fairly volatile journey, with the stock being up a massive 208% from 5 years ago to the peak in October 2020, before declining nearly 60% to today's share price. Alibaba's current share price is 138% off an all-time high. As always, a share price graph doesn't show the full story. In case you're wondering, Alibaba has never paid a dividend, so that hasn't been weighing down on the stock price. But they have been issuing more shares in the past 5 years, which is common for young growth stocks, and is definitely nice to see that they haven't been issuing as many over the past couple of years. On the right, we can see Alibaba's market cap, which is slightly easier to see the growth of the company than just a share price graph. Revenue has impressively been growing every quarter for the past 5 years, not even negatively affected by the pandemic. Earnings per share was growing very well from 2017 to 2020, but it's been fairly stagnant over the past 2 years. Next is debt. So my last stock analysis video was on AT&T, which has a mountain of debt. Alibaba is the opposite. They have a total debt of $28.5 billion and $76 billion in cash, which is very impressive. With the exception of 2017, operating cash flow has been higher than their total debt every year. As well as keeping debt low, they have been increasing equity and therefore has been reducing their debt to equity ratio. Lastly is they actually earn more interest on their cash holdings than they pay in interest on their debts, which is very impressive. That was the past 5 years, but how does the future looking for Alibaba? As we saw, the share price has been performing pretty poorly recently, but is it currently fair valued? Simply Wall Street have them at a fair value of $186, which is 32% undervalued. Current price to earnings ratio is sitting at 16.4. Alibaba has a 5-year average PE of 33.27, and the S&P 500 is currently at 25.81. So it seems that Alibaba is being treated as if their growth is going to slow down massively in the next few years, or is there potentially something else affecting their share price? An important thing to remember is just because something is undervalued doesn't instantly make it a good buy. Alibaba has faced some big headwinds caused by the Chinese government. For example, they blocked the IPO of Ant Financial after CEO of Alibaba, Jack Ma, spoke out against China's banking laws. Alibaba then also received a $2.8 billion anti-monopoly fine for abusing its market dominance. But in fairness, it seems that this was pretty justified when looking into their anti-competitive practices they were using. But the main concern surrounding the stock currently is the delisting concerns. Alibaba, being a Chinese company, has created some issues regarding the stock and how it is listed in the US stock market. So they are currently listed on the New York Stock Exchange, but you aren't buying shares in Alibaba directly. You are buying shares in Alibaba Group Holding Limited, which is known as a Variable Interest Entity, or VIE, located in the Cayman Islands. This is because the government doesn't like foreign investors owning shares in Chinese companies. Foreign investors then buy into the VIEs, which is then entitled to the profits of the companies. The VIE acts as a kind of middleman. So the delisting concerns are from the rules that US listed stocks have to prove that they're not controlled by a foreign government and that they have had their accounts audited by a firm that is certified by the PCAOB. But the Chinese government currently forbids the PCAOB from performing audits on Chinese companies. The Holding Foreign Companies Accountable Act would see companies delisted if the PCAOB were unable to inspect these companies for 3 consecutive years. So what would happen if you own Alibaba shares through the New York Stock Exchange and they were to be delisted? Well, firstly, you wouldn't just lose your shares. They would be reduced to trading over the counter as opposed to on an exchange. The biggest worry is with companies delisting from the stock exchange is that many ETFs can't own shares in non-listed companies. Therefore, they would have to sell them, causing a massive share price decline. So this is, of course, a massive concern, and all the skepticism around the company seems to be justified. But this seems like a risk to reward balance. So thanks for watching. Please like and subscribe if you enjoyed, and let me know if you think Alibaba's strong growth and upside is enough to outweigh the risks of delisting in the comments. Why not also check out another recent stock analysis video on AT&T, linked on screen now.